So let me move to John Oliphant. I'm going to skip Sandra for now. And John, you're the chairman of CRISA. Maybe you can first tell us about what you do a bit more at CRISA, but also tell us about some of the most effective and proven models and instruments in the market to really to try to attract private institutional investors in regional projects and in infrastructure projects in Africa.
Okay. Thank you for the introduction. Morning, ladies and gentlemen. My task is very simple because it's mainly to say how do we match these opportunities that have been unpacked with capital that is looking for investment opportunities on the continent. Just to give you some stats, the total savings industry in South Africa, it's about 8 trillion. If you convert that to dollars, it gives you about $540 billion. And the actual pension industry in South Africa, it's about $250 billion. Okay? If you look at the rest of the continent, there is about a total of about $300 billion of African capital within the pension fund industry that can invest within the continent in terms of growth. And then if you ignore Africa and you look at the rest of the world, there is a study that is usually done by Towers Watson, where they look at what they call the P16, which are the 16 largest pension markets in the world. The total assets for the P16, it's about 36 trillion US dollars. Obviously, the US is a significant market. You know, it's got about $22 trillion in terms of the pension fund industry. So the challenge then that we have as Africans is how do we mobilize our own resources in the continent, you know, referring to the $300 billion to invest on Africa's growth story, in particular infrastructure. And then the second question is how do we mobilize external funding, which is the $36 trillion that is sitting with the P16 to be allocated for Africa investment opportunities. Now, the reason why there are certain challenges within the continent, it's mainly sometimes the contradictions that emerge within regulations. So what you would find is that if you look at, for example, within the South African context, you've got what we call a Regulation 28, which says, you know, you can only allocate 5% of the portfolio to opportunities outside South Africa, but within the rest of the continent. Now, is 5% sufficient, and are many pension funds sitting on that 5%? And the answer is no, and the question is why, and that's what I've been asked to answer. But then externally, you've got a situation where you've got 36 trillion, and everyone agrees that Africa is the last frontier in terms of growth. So the question is, if Africa is only 2% of global GDP, and everyone expected to double and triple and so on, and there's no growth elsewhere in the world, why isn't a lot of capital flowing into the continent? My attempt to answering these questions, it's mainly around the perception of risk. So often people overprice risk, so we all perceive a risk in different ways, and we want to be rewarded for that risk. So in the context of an investor outside the continent, you know, they don't want, and last night we had a dinner, and I called it a career risk, or what you classify as the CNN risk, whereas, you know, somebody, you know, formulate their view of the continent based on what they see on CNN. You know, if you see, for example, what happened in Marikana, you would have assumed that South Africa was up in smokes, you know, the manner in which it was reported by CNN. Now, what you find is that if Africa contributes for 2% of global GDP, it means 98% of economic activity is happening outside Africa. So if you were to be the CIO of Calpas or Calstras, and you want to allocate capital towards the continent, if you were to allocate 2% of the portfolio, you will be sitting almost on a neutral weighting on a GDP basis. Now, surely as Africans would also want to give that person the comfort such that if they allocate 2% of the $36 trillion, which can make a huge difference, you want them to also be spending 2% of their time on that investment. Because what you don't want is to have an allocation of 2%, and then as a CIO, you're spending 60% of your time nursing this investment. So our responsibility is to come up with instruments that allows a person sitting in the US, which is the largest pension market, or somewhere in Europe, to make an investment and forget about it. They don't have to be spending or explaining to the investment committee if there's a bad story about Nigeria in the news, there's a special investment committee. We don't want those type of stories. So I think that's one of the challenges. What type of an instrument do we need to create that can give comfort to offshore investors? Within the African context, I think most of the bottlenecks are mainly around the regulation, and there must be a way to harmonize regulations across the continent to allow a cross-border investments, cross-border collaboration among the investors. So one of the ways in which you could address the issue of investment on the continent is to take advantage of the strengths that we have within the continent. And I mean, we know that the JSE, is the largest, stock exchange on the continent. It's highly liquid. So the question is whether can one come up with models that allow the full utilization of the listed markets. And I think in this example, I was proud to have been one of the founders of Gaia Infrastructure Capital, which is a listed special purpose company that is aimed at investing in infrastructure in South Africa and on the continent. The other issue that we need to be in a position to address is the issue of the skills gap that exists within the key decision makers within the pension fund environment. We'll all appreciate that being a pension fund trustee, for example, it's a part-time job. You only attend 4 board meetings, you look after the assets, it's not your everyday activity. And many pension funds, as a result, cannot afford to match having a board that meet 4 times a year with an in-sourced team, where you've got team that can look at these investment opportunities on a continuous basis and report back to the board on a quarterly basis. So, and what you find, the results for that is that outside Eskom Pension Fund or GEPF, a significant number of pension funds in South Africa have less than 10 billion rands assets under management. So it will not make sense for those pension funds to employ a team of experts internally to do investment analysis and do due diligence and so on, and make recommendations to the board. And that's why in that regard, one feels that one of the instruments that are required is the one that will close that gap, allow smaller pension funds to participate in infrastructure opportunities in a more diversified manner, and in a manner that is safe for the trustees. And surely I think there is a space for a fund of fund in that regard. And again, I'm glad to have been involved in establishing the first infrastructure fund of fund in Africa. You will appreciate that, having moved from being a public servant to being an entrepreneur, when you are given an opportunities like this, you also have to reflect on some of the initiatives that you are involved with that allows private sector pension fund to participate in infrastructure opportunities. So I try to give a broader perspective of the total amount of capital that is out there looking for a new home. And it's only up to us as Africans to find solutions that allow that fund, that capital to participate in opportunities, because there aren't any opportunities elsewhere in the world. Thank you.
Thank you very much, John. Certainly, the kind of numbers that you've put on the table are quite attractive. Even with 1% would be already extremely good. And of course, we will take 2% of that volume of funding for African infrastructure. But also, you propose a number of steps, including creating appropriate vehicles and instruments that could be useful for attracting private investors, private institutional money in the continent. But at the end of the day, we need to make sure that the project that we are offering for investors' participation provide an appropriate risk-return balance, and certainly that the risk is reduced or mitigated. So,
doing business in Africa, you can't afford to be without Africa Investor.